Okay, hello everyone. For today, we are going to discuss the financial plan. So for this, I gave you 2 weeks to submit this. So 2 weeks duration to do this activity. Okay, so let's start the explanation session. Okay, so this balance sheet is what we call the projected comparative balance sheet. So you are going to do this. So this is a simplification of the projected comparative balance sheet that should be developed under the guidance of the firm's accountant. So on your case, you can do research on the actual amount of the following criterion. No? So you have the current assets. No? You search for the actual restaurant operation. And then you can just add or deduct amount based on the research and based on your survey, your projected sales that may derive from the previous discussion, the calculation of projected sales. No? So with this, again, these are the criteria. So the cash, the current assets, so how much is your current assets, food inventory, and the total. Okay, so the fixed assets, you have the building, the furniture, land improvements, and the total. So for putting up your business and indicating how much will be the amount of each uh, factor, no, of each criteria, you need to be realistic. Okay, that's why I asked you to research for the figures. No? Of course, in the Philippine setting. Okay, so how much is your total assets? No, from adding the cash or the current assets, no, includes the cash and the food inventory, and then the fixed assets that includes the building, furniture, and fixtures, the land improvements. So you just add that, and then for the liabilities, no, accounts payable, the note to bank, the total, okay, and the long-term liabilities such as the mortgage of the building, no, and equity, capitalization, that's 80,000 here in the example. Okay, so you need to have the sum of all of that. So you have the liabilities total, the long-term liabilities, and then the mortgage. Sorry, the owner's equity. So you have the total here. So this should be balanced with these assets, and then the liabilities. Okay. So for the 2004, okay, so note that the balance sheet shows a projected comparison between the assets, liabilities, and capital for 12-month period. So the balance sheet illustrates a number of projections that must be made by the person or firm preparing the financial feasibility. So of course, for the next year or projected year, so this is just an example that your assets should, and then your liabilities should decrease. So in this example, it increases well, but much better if some of the criterion, for example, here the need to back decreases to 35,000 from 40,000. So as well as the long-term liabilities also decreases. Okay. So for the equity, okay, so in order for you to get the owner's equity, you just subtract the total assets to the total liabilities. So here, the $316,000 subtracted to $48,000, the current liabilities, and the long-term liabilities of $175,000. So the 93,000 capitalization. So for the capitalization, it should increase, okay? Because again, that's the difference between the total assets and the total liabilities. So you need to have 2-year comparative balance sheet. Okay. Next, you need to have the pro forma profit and loss statement. So the pro forma profit and loss statement is should be prepared by the owner, the manager, or other persons that involved in the management of the food facility. So this is the projection of the income and the expense for a particular period of time. So for the financial feasibility study, you need to have 3 to 5 year projection in order for you to be considered, or the feasibility financially will be considered sufficient. So the format for the P&L should follow the uniform system of accountants developed for hotels and restaurants for categories that fit the needs of the food operation. So you have here for 2003, you have here the food sales, the cost of sales that should be 40%. In order to get this, you will multiply, or you will get the 40% of 400,000, as well as for the beverage sales, you need the 30% of the beverage sales in order to derive for the cost of the beverage sales. So you can use the following percentage of food cost. Okay, so and then you need to add for the food sales, and then for the food sales, deducting the cost, okay, and the beverage sales deducting the cost as well. Okay. Okay, so again, in order to get the gross profit on sales, you need to have the difference first of the food sales minus the cost of food sales, which in this example is 160. So you need to have the difference between the food sales and the cost of food sales. So the total is, you need to have the difference. So that's 240K. That is 250K. Okay, 240K rather. And then you need to have the difference between 200,000 to 60,000 minus 60,000. So that's equivalent to, so that's equivalent to 140,000. And then you need to add 240,000 to 140,000 is equivalent to 380,000. Okay, so that's on how you get the gross profit of sales. Okay, of course, in projection for different years, 3 to 5 year projection, it should increase. Okay, so you will research, you will look for the figures, realistic figures, for restaurant operations. If you are going to operate a restaurant, or the facility that you are going to put up, you need to have realistic research or figures for that. Okay, and then controllable expenses, you have the following criterion. Salaries, wages, benefits, supplies, insurance, entertainment, utilities, maintenance, replacement for the equipment, for plates and other materials in your operation. And then for the general, so you have also included that. Okay, you need also to include that. Okay, so and then you just total. You just add all of this. Okay, just add. Okay, add all of the factors or the under the controllable expenses. Okay, so for the fixed expenses, So the general expenses here may indicate the emergency fund or the emergency uh, uh, amount of the that you will allot for some other uncontrollable expenses, no? Or some other expenses that might uh, experienced by your establishment. Okay, so that's why in this uh, this is uh, this is not specific on where this amount will be spent to. No? So for the fixed expenses, you have the the real estate and the lease on land. So as you can see, uh, from the different years, no, it doesn't vary because that's fixed expenses. For this um, uh, controllable expense, as you see, as years differ, no? So the total increases, the total amount of controllable expenses increases because of factors, no, affecting the that might affect the sales. Okay? And then everything will follow. You might have change of menu, you might add labor, you might add equipment, you might buy different materials, uh, needed in your store. Okay, so that's why it increases. And then the total controllable and fixed expenses, you just add. Okay, so add the fixed expenses sa controllable expenses. Okay, so in order to get the total for the controllable and fixed expenses. Okay. And then for the net profit before taxes, so in order to get the net profit before taxes, okay, you need to uh, subtract the gross profit. Okay. So subtract the gross profit okay. Subtract the gross profit to the controllable expenses and then the fixed expenses. So in order for you to get the net profit before taxes. Okay. So in doing 3 to 5 year projection, again, you need to really study this example, in which you will increase or decrease, your projection of figures or projection sales, So of course, for the sales, you need to do that higher. You need to have that increase per year. For the you need that to decrease per year. But if the situation needs you to increase that, for example, like what I've said, if you need to have to hire additional employees, if you need to add equipment, then you may do so. You add additional employees, of course, the salaries and the wages also increases. And then if you have strategized that you have strategy to decrease equipment and to change or revise the menu. So it will also have it will also has effects, or changes for the controllable expenses. It might be higher or might be lower. Okay? So for the fixed expenses, that's fixed. You do not need to pay. So that's on how to do the pro forma profit and loss statement. Okay. Thank you very much. So I hope you learned something for the financial plan. If you have questions, kindly feel free to ask. Again, thank you very much and stay safe, everyone.